Welcome to another edition of Reinvent the Future of Money. My guest today is Olaf Ransome, also known as the Bankers Plumber, a man who spent the first part of his career at institutions like Goldman Sachs, Credit Suisse, and Nomura, ensuring that their financial pipes flowed smoothly. He's since transitioned to advising a new breed of financial market infrastructure at the intersection of traditional finance and digital currencies. This includes Fnality and RTGS.global. Today we'll be speaking about liquidity, why it matters even if it's not always the sexiest topic, and what the future holds for regulated digital currencies like stablecoins, central bank digital currencies, and the hot new entrant on the scene, commercial bank deposit tokens.
Reinvent is brought to you by Millicent Labs, building the financial infrastructure of tomorrow, where the power of Web3 meets the simplicity of fiat. Learn more at millicent.io.
So, Olaf, thanks very much for joining me today. Great to have you here. It's been a while.
Super. Real pleasure to do this. I think we got the timing just about right here. Liquidity has been a topic in the last weeks, and perhaps more so than it ever is. You referred to sort of sexiness at the beginning. You know, all this plumbing stuff, it just ain't sexy. Hasn't been, and a lot of times people take it for granted. So this is wonderful to, what would you say, exercise the mind on things we need to do in and around the space.
Yeah, I think that's very well put. And I mentioned in the intro that you were with Credit Suisse for about a decade. I think it was in pretty good shape when you left. So what happened?
I think over the years, there has been some consistently bad management that has led to losses. And I would say even when I was there, there was a series of things where you did wonder, was this, if you think back to the Pac-Man game where you avoided the ghosties, I think the Credit Suisse game would have banana skins, but in the Credit Suisse version, you try and slip up on the banana skins. And you did have the impression sometimes like, geez, how much trouble can you really get into? But actually very early on in my CS times, we started thinking about liquidity. I had the good fortune to be appointed the global program manager for all things CLS, which is where we now settle our FX, and we kind of take it for granted. It's a thing, and a very vital piece of our plumbing. And very early on, we looked at what was set up, and we had two parts of Credit Suisse. We had the Swiss part and the non-Swiss part. And as in all large organizations, funnily enough, the domestic part and the non-domestic part didn't really like each other very much. And this was investment banking, so it was a little bit exacerbated, but I'm sure you could tell the same tales of bankers of Deutsche Bank in Frankfurt and the bankers at Deutsche Bank in London. Nothing particularly unusual. We looked at the way the cash moved, and the Swiss bit made its decisions about what banks it wanted to use as correspondent banks, and the non-Swiss bit made decisions. They kind of talked to each other, but it effectively ended at, you and I having a conversation, and you go, hey, I like Citibank for euros, and I'm in Switzerland, I'm going, no, I like Deutsche Bank for euros. And I go, Kene, your choice sucks, and you tell me that my choice sucks, but we don't have to agree, so we just agree to disagree. And we were looking at this with CLS coming along, like, guys, this isn't going to work. We're going to have liquidity all over the place. So even as long ago as 2002, we were talking about liquidity, and even as long ago as 2003, collateral management, how do you move collateral around the world globally? This was a theme. This I can point you to 5 working group papers on stuff in the area. So liquidity is not new. Where did Credit Suisse come a cropper? They came at least in part a cropper because people removed assets of both kinds. So they removed cash, which is unsecured receivables in a bankruptcy, unless it's insured. And they also removed assets, which is a bit of a double whammy, because if the assets go, you're not making any money. You can't pay for all the fixed costs that are there. So there was definitely a bit of a retail problem in Switzerland with money flowing out. I'd seen various reports that said over and above what happened in the last quarter of 2022, in the week when things started to get very shaky, they were losing 10 billion Swiss a day on a deposit base of about 240, 230, 240, somewhere around there. That's a lot of money per day. And I was doing a bit of research for an article on liquidity that I'm writing that you kindly commented on. When Northern Rock was going under in 2007 in the UK, they were losing 8 billion or something in deposits, but the UK's 8-9 times the size of Switzerland. Same with SVB. Silicon Valley Bank had lots of money going out too, but relatively not in those sizes. So I think they had a retail
40 billion in one day, maybe SVB. I think I've heard. And
I
think
the US is how much bigger than Switzerland, please?
Yeah, of course. Yeah.
So in both cases, it was retail. In both cases, I think internet speed has played a role. If you go back to the economic textbooks and read about runs on banks, or what's the film? It Was a Wonderful Life, I think. It's people queuing up in front of the bank, which is a whole Northern Rock thing as well. But now it's like whoosh. The Bush Telegraph works real quick, and it's just a giant echo chamber. So that's the retail side. And then it feels like they also had a big institutional problem that people were not helping them fund. So, Credit Suisse is relying on being able to swap Swiss to dollars, Swiss to pounds, and people weren't stepping up to do those trades with them. And so I know this for sure. I was talking with the treasurer of a bank in the Southern Hemisphere, and I better be really, really careful about how general I make this. So it's not clear exactly who this is. But the comment from this particular corner of the world was, haven't dealt with Credit Suisse for 8 months, toxic, didn't want to deal with them. And this is even before the crash. So you've got the wholesale markets drying up, and as the old joke goes, if the market thinks you're liquid, well, guess what? You're liquid. And then I think you had another factor that played into that, which is a sort of global factor, that banks were on shaky ground generally after Silicon Valley Bank, Signature, Silvergate, that they all had to lock down, and problems at First Republic and all the rest of it that were there. So my sense is that certainly the Brits and the Yanks had looked at what was going on that week and, geez, there's a chance you can't settle your trades next week because you need so many dollars. And I think they've rung up the Swiss and gone, guys, if you don't sort this out by Sunday night, we're all going to have a gargantuan problem. And to try and put gargantuan into context, in those early days at Credit Suisse, I was there when there was a very small mistake that CLS, in fact, the only time, to my knowledge, it's ever happened, where some trades didn't settle very early into the process. Minor technical thing went wrong. Computer did what the computer would do and just shut the day. We ended up some 30-odd thousand unsettled transactions. Money in the wrong place, all over the place. Only 39 banks involved. It took us 6 months to sort that problem out. 6 months. CLS now does a million trades a day, right? So if you can't settle trades, it's really, really, really serious stuff. So I have a sense that, and this is mosaic theory of reading between all the different commentaries, I think that the Brits and the Yanks were well attuned to that, and they're ringing up going, this isn't going to look good if we can't settle trades, which got you down in the Credit Suisse case to two possible solutions. One was nationalization, and the other was a commercial solution with UBS. And my simple, and this is now not bankers plumbing, this is now politics. My simple view of it was that nationalization alone wasn't enough, that the message it would send wouldn't have been strong enough. And then the pressure was on that they needed something that looked vaguely commercial to send a strong message, which was the UBS solution. You can philosophize on the last bit of that. That's really interpretation. But clearly, there was a big, big settlement problem because the central bank had to say to Credit Suisse, hey, we'll take collateral we wouldn't normally take, which happens from time to time in other jurisdictions too. And we'll arrange with the Fed to get a fistful of dollars versus Swiss francs, and then we'll sell them to you. So, yeah, they got whacked. What have you got? You got run on the bank. Oh, you got mismanagement, run on the bank on the domestic side. You got a crisis in the wholesale markets, and you got geopolitics playing in there. There you go.
Yeah, I mean, getting hit from all sides. Fair enough.
Without a doubt. All of those, all of the above.
Yeah, I think that what you said about the internet speeds playing a big part in some of these bank runs that we've seen lately, the three S banks in the States as well as Credit Suisse, it's not queuing up around the block anymore. Like you said, it's waking up and reading a tweet and deciding to pull all of your money on your mobile phone before you've even had your morning coffee.
Yeah.
I know that you've been working on some of these newer digital projects, like you were involved with Fnality before it was Fnality, back when it was a research project called Utility Settlement Coin. I believe you've also done some work with RTGS.global. How do you see some of these new digital providers making things safer now that we're moving towards a very high-speed, high-velocity environment with electronic and digital money?
So the proposition behind both of those is that you create a system where all the balances are backed by funds that are at the central bank. That's one quality. The other quality is not only are they backed by funds at the central bank, but those funds are ring-fenced from the operating company. So to make this clear for anyone who's listening to this podcast, of course, there was JPM coin. And oh boy, did they ever make a lot of noise about JPM coin. And Jamie did decide it was a good idea to say that, well, we've got a fistful of dollars at the Fed. And he's right. At any given time, JP have indeed got quite a big fistful of dollars at the Fed. But if JP issued 1 billion JPM coin, even if JPM had 5 billion at the Fed, if something happens to JP, you have not got, if you're one of the JPM coin holders, you haven't got a claim on the 5 billion. You're an unsecured creditor like everybody else. So the whole, the original driver of the whole Fnality thing, what was the Utility Settlement Coin project, started with assets are going to be digitalized and they're going to be on chain. How do we pay on chain? And then the second thought that came into that was, if we're going to pay on chain, let's pay with central bank money, which we know from the PFMI, the Principles for Financial Market Infrastructure, is the preferred way of settling things. That makes perfect sense. And that's what underlies the whole idea behind Fnality. Now, in Fnality's case, assets on chain hasn't happened quite as fast as anybody would like. That's a slow train coming as it goes. And the same logic sits behind RTGS.global that says, can we connect ledgers to make payments where everything's backed by central bank money? Both of them will work, actually. From a technical point of view, great. Then it comes down to interoperability in each case. In interoperability, that's programmability, and that means, can my pile of cash interact with settlement mechanisms that need it? And an example of that would be to do intraday trading. Now, let's take the Credit Suisse example we had earlier and try and project that to normal times. In normal times, Credit Suisse could take its collateral, go to see the Swiss National Bank and say, can we have some Swiss francs? And there's perfectly good repo arrangements for them to do that. And in fact, they can do intraday repo, they can do overnight repo. Very standardized, very established, very well used. No matter how many Swiss francs Credit Suisse have got now, it's of no help if they need dollars now. It doesn't do them any good. And if we just ignore current events, the only possible way Credit Suisse could get their dollar payments made was to send lots of dollar payment instructions to their Nostro, the Bank of New York, and say, please make these, which resulted in overdrafts and all the rest of it. So now you can imagine there's an intraday marketplace, and the new UBS goes along and says, great, I got a fistful of Swiss francs, I need some dollars. So I'll give Swiss francs as collateral, I need dollars. And there's a bank on the other side. Let's pick Goldman Sachs, because if there's a market around, Goldman Sachs would love to make a market. That's always true. Goldman Sachs would go and say, terrific, we've got plenty of dollars, because we got Marcus and we now got a nice deposit base. We'll rent you those dollars for the rest of the day, for the night, whatever, and we'll take Swiss as collateral. We'll do that trade now, instantly, and settle it. And we'll make sure that Goldman has got dollars and UBS have got Swiss francs. and will debit those amounts and transfer them instantly in central bank money. Suddenly, everybody's really happy. UBS have swapped what they've got for what they need. That's great. It's happened instantly. There's no counterpart credit risk. There's no delay. There's no use of overdrafts. So you've got to pick up on the balance sheet because you haven't got CCR, counterpart credit risk. You've got to pick up because you haven't got liquidity buffers to support all the overdrafts. Everybody's happy. And I can tell you categorically, if you go and see a treasurer and go, treasurer, would you rather rely on overdrafts from your nostro, or would you rather trade and pay variable costs as you go? They'll pay variable costs as you go. And if you then say, I've got this great new intraday marketplace, so you can trade as late as you like. There's optionality. You don't have to trade early. You can trade late. You give any trader optionality, they'll take it all day long. So you can see where we can get to with both of those things. In both cases, whether it's a Fnality or a RTGS, you're creating a payment system. Our payment system is an FMI. There's a whole bunch of approval processes going along with it. Fnality, by design, wanted to be on chain and use decentralized systems. Decentralized is admirable because it helps with single points of failure and so on. But as soon as you had the word chain in it, that of course meant, there was a whole load of more questions being asked. Inevitably, that we do entrust the central bankers with being cautious, even if sometimes that we can criticize them being overcautious. So there's a whole bunch of approval processes going around these FMIs. Most of it, for the good. We can philosophize about delays and all the rest, and we need to put those things in place. I will add that it won't help us if we have multiple solutions in each currency.
Yeah.
You don't need a CBDC and a Fnality and an RTGS in dollars.
I think that's probably fair to say. But that brings me to another point. CBDC, wholesale and retail, two separate things.
Yep.
But how is CBDC going to live alongside privately issued currencies? Once, let's assume that we've got CBDC wallets. You've got in the euro, I think you've got a limit of 3,000. Here in the UK, I think we're looking at 10 to 20,000. But the economy also needs commercial bank money, which is where the commercial bank deposit token idea has kind of caught on. And JP Morgan, who you mentioned earlier, have released some papers around this. But how are these different types of digital money going to live alongside each other?
So I think on the retail side, what you'd see that retail take a big wallet share, no pun intended, because it's guaranteed money. Now, not everybody is going to get a wallet. You saw this thing in China where they did the experiment that you can have it as long as you got a bank account, but you can't have a bank account unless you're resident, and so on. So chances are that retail won't serve all the purposes that are there. I can see why you do it, although if I hark back to what one of our local regulators here said, Andrea Mettler is one of the three in the office of the chairman of the SMB. Yes, we have no need for a retail CBDC whatsoever. None of the benefits are things we have problems with here. The only one you could point to would be geopolitical. It says, if this stuff's going to happen, let's make sure we own the tech. Because it's really bad if you're reliant on foreign powers. Just go and ask the Germans about gas. Oh yeah, probably wasn't such a good idea to cozy up to the Russians. So I get the geopolitical thing on retail, and you'll get some of it. And the alternative is private money. That private equivalent could be a stable coin. And there's nothing a priori wrong with stable coins. You just got to be sure what the promise is. Is the promise reduction of par? And if it is it properly regulated and behaving, are you behaving more like USDC and Circle than you are like Tether? That is a very broad church and a gap between the two. So in that sense, those could coexist. I think in the wholesale in the wholesale thing, it would be really difficult if the things coexisted. Although in payment systems, you've got the Fed wire, and that competes with TCH and chips. You've got FedNow, which will compete with real-time payments, and the same in Europe, which I actually think is a bad thing. I don't see how you can simultaneously be a regulator and a payment system operator. That's wrong. I think they failed to have good governance in those cases. So if you want a CBDC, great for wholesale, go ahead and do it. But then make it very clear you're doing it so that the private sector doesn't waste its time trying to do the equivalent. And then the Fnalities and RTGSs of this world will do what they're going to do. I would, with my Bankers Plumbers hat on, I'd say that a benign monopoly in each currency is a good thing. We get into the economics and textbooks and all the rest of it, but it's certainly no good if you fragment liquidity, which will help us neatly when we get onto the discussion of tokenized deposits. If I'm operating and using Fnality for dollars and you're using RTGS for dollars, the twain ain't going to meet too easily. And in fact, I was talking with somebody we know, with Chris Ostrowski at Soda Public Money beforehand. I gave the answer, because he was talking about interoperability and level ones and what have you. And I said, this is the same as CCPs, central counterparts. For years, we had central counterparts. And if the two of us wanted to do business, both of us had to be members of the same club. And then there was a bit of noise about, well, what happens if we want to be members of different clubs? To which the first answer was, well, that will be really difficult. And then the second answer was, well, we should have interoperability. We only tackled that one years after we'd had CCPs. So to go from a world of nothing to interoperability is like, wow, how's that going? We don't even know how the basic thing is going to work. So how are we going to get excited about that? So I just don't see how in wholesale you could readily have interoperability between different solutions.
Okay. So I guess here in the UK, we've heard from the Bank of England in a couple of speeches that, the private sector is doing good things in terms of the Fnalities and the RTGS.globals, and that maybe there's no need for a wholesale CBDC, and the bank's own RTGS systems undergoing renewal, and they've now said that things like distributed ledgers will be able to plug into it. So it seems like the wholesale side is moving along, at least here in the UK, quite well without a CBDC. The bank, however, is very keen on issuing a retail CBDC, and we've seen, I think they're hiring 30 people for their CBDC team here in the UK. And you mentioned earlier that stable coins are not necessarily a bad thing from anyone's point of view, and the bank has said that they're open to the idea of people backing stable coins one for one with their central bank reserves or treasuries, what have you. None of that creates new money, which we need for the economy. JPM coin, on the other hand, does do that.
Yes. So
the JPM coins of the world have now started to put their arms up and wave and say, we're doing tokenized deposits. Tokenized deposits are good because there's a risk of, commercial bank disintermediation, which would be bad for the economy because we need things like mortgages and business loans.
Yeah.
What's the problem with tokenized bank deposits in the way that they've been presented to date?
So, completely with that, we do need the two-tier, and that's the whole so-called run risk that goes with this, that says if everyone's got access to the risk-free asset, they'll go buy it. And that's the whole financial stability, monetary policy, and I had the delights of writing a very thick paper on all of that. Fnality, the private paper, with my good friend Daniel Heller who's ex-SMB, and that's tough stuff to explain all of, so I get all of that. Now, my problem with tokenized deposits is have you got what the BIS refer to as the singleness of money. And the way I look at this, it can be, okay, today, if you pay me some money, you pay some money to my account at, let's say my business account at Credit, it's still at Credit Suisse. I've got an unsecured receivable on Credit Suisse and everything goes in that pot. If, however, you sent me some UBS tokens and somebody else sent me some tokens from the ZKB, one of the other banks here, so you send me 200, somebody sends me from ZKB 100. Yeah, in total I've got 300, but they're not fungible. There's not singleness of money. If I now had to go and pay 250 to Chris Ostrovsky, I'd have to ring him up and say, Chris, you know I owe you 250. Well, I got some UBS coins and I got some ZKB coins. If he did his business properly, and being Chris, he probably would, he'd have to do real-time risk management on all of that and go, well, hang on, have I got enough room to take that risk? Of course, if it's only 200 and 100, the answer is he probably has. But if we do this as per the textbook, he's going to turn around at one point and go, no, I don't want any more UBS coins. Can't take them. And if you just think about how absurd this thing has been, in the normal course of events, I just bang out a payment, I pay him 250, he's happy, proverbially he does not touch the sides, hot knife through butter, whatever you want to do. It's all reasonably STP. I don't have to call Chris and chat about football or whatever and then which coins he's going to accept and all. That model doesn't scale. It just doesn't scale. So I completely get why JP created JP Coin. Perfectly good new rail inside of JP. Fantastic. And they, like all other large institutions, I'm sure their payments infrastructure was somewhat old and was probably programmed in COBOL. And they had to come up with a new thing. And somebody said, we, the programmers, want to do blockchain. What the hell? Knock yourselves out, guys. Go do the new sexy stuff. Because if that makes you happy, and JP can do stuff 724 and everything using this new rail. And it's if you and I have got accounts at JP, terrific. Debit, Kene, credit, that's marvelous. No problem at all. Doesn't matter whether they process it in JPM coin or on their legacy systems. Whatever. Works perfectly well. But as soon as you try and move that JP coin outside of JP, it's the same as tokenized deposits. Somebody's got to do the whole real-time risk management stuff on it. Now, if it were to be backed with central bank money, a whole bunch of stuff's got to happen. Because if you think about it, JP has a lot of money at the Fed, but if the music stops, everybody's an unsecured creditor. So JP would have to have the ability to, for the sake of argument, create a sub-account at the Fed and say, great, we've issued 100 JP coins, there's 100 in the sub-account, and that sub-account is ring-fenced and bankruptcy remote from all the other things that JP do, so that if anything happens, anyone who's holding the 100 JP coins, collectively, they can go see the administrator and go, Mr. Administrator, collectively, we'd like our assets. Yeah, and Citi could do the same, et cetera, and then they would be fungible. So a lot of ifs in that, and a lot of stuff that would have to happen, which is practically what Fnality has proposed as a common enterprise across all the banks. So I'd look at that and go, what's smart here? Does it make sense to create one thing in each currency? Yes, because we've already established that if we fragment things, it's not good. Do we really need to create a JP ring-fenced coin, a Citi ring-fenced coin, a Wells Fargo ring-fenced coin? If it's Wells Fargo, they're probably going to issue 7 times as many things because their track record says that they're not particularly good at their controls. So are you really going to trust? Are you going to trust Wells Fargo that they didn't issue 7 times as many Wells Fargo coins as they've got actual amount of money in the bank? Yeah, it is slightly funny. We're grinning on this, but based on their track record, you might ask some questions. So I kind of rest my case on tokenized deposits and go, so far, I sure as hell am not convinced. It's just overhead, problems, difficulties, doesn't work for me.
So one model where I think that the tokenized deposits are, very interesting and could come to light in a way that's more congruent with the existing two-tier system. The regulated liability network. Tony McLaughlin from Citibank came out with this idea. I think we're seeing Settle and Digital Asset implement the trial in the States with the New York Fed at the minute, and I think eight big banks. And to be perfectly honest, we're working on something somewhat along the same lines as the RLN at Millicent. And I think that is a really interesting idea, which fits in with the Bank of England's thinking that the CBDC is needed to anchor the money. You need the public money that anchors the privately issued money. And that is what gives the singleness that you mentioned too from the BIS. So the RLN has that idea and that model. But I've seen you've written on, I see your hand shaking as well. You've seen that you wrote on social media a couple of times that the thinking behind the RLN isn't quite mature yet. And I would like to dive into that. Yeah. What do you mean by that statement?
Well, it would be mature based on the number of hours Tony spent talking about it, for sure. Because he's taught this thing to death. We're good mates, so I'll make that joke in very good faith. It looks to me from the initial designs like in the ledger system you can mix commercial bank money and central bank money. So the whole idea is Citibank can effectively put in a subledger and go, great, there's a subledger that exists on this RLN network. And let's just imagine at some point that the balances on that Citi subledger where Kene's account has plus 20 and Olaf's account has minus 20. In isolation, and these things are never in isolation, but in isolation, according to the textbook, Citi would have zero money at the central bank. I'd be like, happy, you've got 20, I've got minus 20, what the hell? The ledger balances. Great. Now, let's go back to the example we had earlier about intraday money markets and now it's FX markets and swaps. So you want that UBS thing to go and do a swap with Wells Fargo, we're on the other side of the trade. If that Fintia machinery that's the marketplace goes and knocks on the door of RLN and it says, has Kene got any money? That 20 is commercial bank money. There's not necessarily 20 at the central bank. And at which point you've kind of, to use an English expression, you've confused the scorers. It's not quite clear what I'm getting. Am I getting an IOU from Citi? Or am I getting central bank money? So if every single balance on the RLN system was backed up one-to-one with money at the central bank, which is ring-fenced, both from the from the bank that issued it and all the other operations, everything, so that everybody who's got the balances or coins, whatever you want to call them, can make a collective claim on the collateral. Terrific. If that's not the case and it's not clear, then it hasn't helped very much.
That's that's an interesting view. I mean, it's also somewhat similar to the existing system in that if the money's not always backed one-to-one, the commercial bank money isn't always backed one-to-one, so you can have a run on the RLN. You could have a similar situation where the partition for the central bank money is completely separate and that people can issue more because things aren't always going to balance out commercial bank tokens than they do, let's say, wholesale tokens. So I think that's the basic model of what Tony's proposing, which on the surface I think makes pretty good sense to me. What I don't understand is how payment stablecoins come into the equation. I guess because they're going to be one-to-one, and there again is that risk of disintermediation. Unless the commercial bankers can pay you interest that nobody's doing at the moment anyways, what's the benefit of holding money with a commercial bank over a stablecoin issuer that's essentially a synthetic central bank digital currency?
If you are you need to get some reward for holding the stuff there, and generally you've got access to the whole network that is the bank, so you're getting all your payments and everything else flowing through there, and if I think of my business in Switzerland, I could get anybody to pay me. It's fine. They can just pay me money to the business account at Credit Suisse and it would turn up. So there's a singleness of everything that's in there. And, if you've got a stable coin, that's not necessarily the case. And then you, as a business, you got to keep track of, well, I got some money at Credit Suisse and I got some stable coins and so on. So, that could fragment liquidity. My take on stable coins is they got their day in the sunshine because of crypto. And they were solely there because if you sold crypto and you wanted to get out of the action for a little while, if you put all the money back to the fiat banking system, it's too far back. You kind of couldn't get back on. And I liken this to playing ice hockey. Ice hockey players don't spend too long on the ice. They very intense while they're there and they get off. If an ice hockey player took his skates off, it would be kind of hard to get back on the ice quickly, right? So the equivalent of not taking your skates off was sitting on a stable coin, which no matter how much you philosophized about it, was better than taking your skates off. Maybe until you got super scared and you looked at Tether's books, but there was an advantage in doing that. And that's where I saw the stable coins making a name for themselves. I can see how private solutions like that are useful. And then in order to avoid this whole problem of disintermediating the banks, you kind of have to, I think you need to distinguish between intraday for settlement purposes and overnight. So one of the things we grappled with when I was at Fnality is, well, how do you sort of say, well, great, Lloyds is a member of the UK, whether they want to keep money at Fnality or at the Bank of England, it's the same. It's the same impact on financial stability and on monetary policy. But what about if Commerzbank wants to keep a bunch of pounds? To which the answer is, it's at that point that it gets a little bit awkward. And then you have to find ways to say, well, what should Commerzbank do at the end of the day so that they're not sitting on these pounds and causing problems? And then there are actually plenty of avenues for them to do something. They could do a reverse repo, take in securities, lend out the money, and so on. So I think it's useful for settlement purposes to have very wide access that during the day everybody can hold the balances, and then you kind of put your financial stability thing at the end of the day to say, well, not everybody can have access to the risk-free asset overnight. Is my take on how to deal with those things, and then hopefully that doesn't disintermediate the commercial banks. And increasingly, I don't think the commercial banks want a role in transaction banking largely. One of the other mandates I have right now, setting up a fintech in Switzerland. And you call up some banks and go, would you like to be the correspondent bank for this new fintech? No interest at all. Don't want to do that. Where am I going to get some access to these different rails? So in fact, we need to provide new avenues to allow this settlement stuff to happen, because that's what we're talking about. So it wasn't, we as a fintech don't want to hold massive dollar balances or whatever overnight with clients, but we need settlement, and that's difficult with the transaction banking environment.
So I guess wrapping up here, let's run through a few quick fire exercises. You talked about game shows a little bit before we jumped on and hit record. So wholesale digital currencies, what are we going to see in the next 5 years? How's that going to play out?
Doesn't strike me that any of the majors are in a hurry to do it. Could happen in minor currencies because they want to be a bit more accessible. So I think you'd expect the likes of Fnality, possibly an RTGS, to play out in one way or the other in the next 5.
Okay. So you see emerging markets as the first at bat with these new technologies then?
Well, possibly with the CBDC side, as long as there are solutions for the majors. So if you go to, I was just down in Africa, one of my clients is there, and I was visiting. All of the African institutions want to swap local currency for dollars, but because it's a swap, the only people who take the credit risk are the South African banks. This is not a trade secret of any kind. This is like, it happens every day. And then the South Africans need to turn around and refinance themselves through rand into dollars, and that whole process is not very slick. Because it's like, geez, well, I've got to get somebody to deliver me some Botswana and Pillau, and if I see that, then I've got to go and get the dollars from over here, and then I got to give them the dollars. There's counterpart credit risk in there because you've got to swap. So you don't do much business. So there's business going begging. On their own, though, an African currency creating CBDC is not much use without dollars, pounds, and euros. So we've got this interesting sort of catch-22 situation. Who moves first to get this thing along? If we've got an answer to the majors, we can then go to the minors for one of them. I don't use the term in any derogatory way, but the minor currency, and say, hey, if you solve this, you can connect to this. And it's worth your making the investment because you can now do more business in the way that we were talking about earlier in wholesale markets and intraday liquidity trading and so on.
Cool. All right. So that actually leads into a good question. Do you think there's going to be a shift in what the major global currencies look like over the next, let's say, 10 years? Are we going to see a shift to a more multipolar world economic environment?
Funny that. My wife asked me this morning whether I wanted to read an article that was in our local paper, the NZZ, on the dollar will be hard to shift. I said, I didn't have any time. I should have prepared better for the question. I think I'll take that one. It's very hard to shift the dollar. You can hear from Asia, there's a lot of desire to do corridors that don't cross the dollar. The answer to that is possibly. That's there. But then to go and create all the mechanisms just to do those corridors feels like there's not enough volume. So theoretically, there's business to be had, but it's insignificant volume to justify creating a great big new process to do these things. So just don't see how you dislodge the dollar that quickly would be my summary answer. Now I'll go away and read might text you a better answer if I go away and read the article.
Fair enough. I'll update the show notes down below.
Yeah.
I think we're seeing a lot of news about de-dollarization, but I think that type of news does tend to pop up once every 10 years or so, and the dollar hasn't really gone anywhere in a while. But it is interesting to see some of the headlines that are coming out. So it's something I'm keeping half an eye on. Right. Retail digital currencies. What am I going to be paying with in 5 years' time? What's my app on my phone going to look like under the hood?
Feels like the Brits will get there, actually. And looking at what John Conliffe had to say, there's like, my sense, reading between the lines of what Conliffe is saying, is like, these things take time to build. So I'm going to make the commitment to build it now. I'll take the risk of being wrong, but I'm not worried about it. I'm more worried if I hadn't built anything and I needed to, because I can't do it quickly. And if you look around, particularly having had the experience at Fnality, if you compare how easy is it to talk to the Brits, the Yanks, and the Europeans, the Brits were front and central and trying to do things, trying to move forward. So it may no longer be the world's biggest currency, but London is incredibly innovative. The bank is very supportive. And I think it's what Conliffe has announced is great. So look, we'll take a chance on this, see where it goes. There's certainly, if John Conliffe's got anything to do with it, we'll certainly do it in a controlled way that's not going to go, totally wrong. So I could see us using that in the UK. In my home country here in Switzerland, are we going to do anything? No, not just not going to happen. I think in any time soon. Because even if we put up our hands and try to have some people's movement to get us a retail Swiss franc, just to put it to, we'd have to put it to a vote. We did like a vote over here. Not happening anytime soon.
And what about the States?
If I just, the only benchmark I've got is my sort of Fnality experience. Where were the Americans compared to the Brits? And they just seemed at least a couple of years behind for doing that. After all, we are talking about an advanced country where they still use checks.
Yes. Yeah.
Advanced country and checks,
I guess,
in the same sentence seems to be like weird. Uncle Sam, by the way, did send my son, who was born in America, some nice checks for COVID relief. Included even a check for $1 as well. It's $50 to cash a check here. And to give you an idea of what happens in an advanced country, he went down to the local branch of UBS where he has his account. He said, I've got this check from Uncle Sam I'd like to deposit in my account. And the young gentleman behind the counter was probably my son, who's nearly 25. What's that? It's a check. Okay, I don't know what to do with one of these. He had to call the branch manager down here in our village to go, what do I do with it? So, given where they're starting from, is it likely that the Americans can be as smart and quick as the Brits? Nah, don't see it. Just don't see how it's going to happen. Technically, they've got plenty of brains, plenty of money, but just looking at all the things that have gone before, you're still using checks, real-time payments. Everybody else had real-time payments long before. So I just, no.
Okay. And Hong Kong, Singapore, they seem to be more open to, I guess, the digital currency side, both public and private. I guess for me personally, I see that slowness to adopt new technologies because of, I guess, the comfort of being the dollar is potentially one of the bigger risks than any kind of political collusion that people talk about when it comes to the dollar losing its role. I know that, there's a lot more than payment rails and checks behind the reason why the dollar is important, but it is interesting to see other people innovating and some regulators and politicians in America really putting their foot on the brakes, where it feels like it's their lead to lose, especially with dollar-denominated stablecoins having 99.5% of the global stablecoin market, for example.
Yes, I think it's exactly that you could show some leadership, but it feels a bit like change in banks, right? I've been inside banks, and banks have got two project books. There's one project book which is the must-do stuff, mandatory, regulated, and there's discretionary. So they always do the mandatory stuff, although inevitably with the mandatory stuff, they try to do as little as possible, as late as possible, and promise to improve everything in version 2, but, like manana, it never comes. And the rest is discretionary. And it's very difficult to get shot for not doing something.
Yeah.
Right? You won't be in that job in a couple of years. So I think it's very easy for some of these regulators and staffers at big government institutions. Nah, we're not going to do that. It's exactly the same with the banks not investing in infrastructure. And some of it, by the way, is quite hard. Just to close with the Credit Suisse example, their ledger system is called BS70, Booking System 70. And their securities processing is called WS80, Red System, which is Securities System 80. These refer to the years of their birth. Yes.
And I assume both are coded in COBOL, which was invented in, 1959, I think.
Yeah, exactly. So there's all of these inertia things, but fundamentally, whether you're inside a big bank or even when you're at the Fed, all these places, it's very hard to get shot for not doing something. And as you rightly said, the dollar has got all this dominance. People have tried to write its obituary and fill in the time of death. They've been great. Rumors of the death have been greatly exaggerated to coin a phrase. So there's not any real sense of urgency. Whereas I think you've got, if I just look at all the things that the Bank of England have done, the things they've done cooperating with Fnality to change some of the policies, how the Bank of England works with the Treasury, how Congress particularly has been front and center in saying, these are things we're going to do. You're just not seeing that in the States. So yeah, it's kind of unfortunate. And, maybe they end up as the frog in the water that's heating up with these things. But and they'd have all the brains going to do this in a sensible way. But the wheels of politics over there grind in mysterious ways. Ours in Switzerland just
I do think that here in the UK, I think we're in a good place in that, like you say, Fnality's been, cautiously embraced might be the correct term to use. Yep. The Treasury recognized them as an official payment system last year. The Bank of England rolled out the omnibus account system. The RTGS renewal is openly said we can connect to technologies like distributed ledger technology. So they're moving in the right direction, and I think London certainly realizes its financial services scene is what makes London London these days, and a big important part of the economy here.
Yeah.
The Europeans moving ahead with the digital euro, slightly different perspective or take on things than here in the UK, but in all, it's an interesting landscape and something to keep an eye on. But I think we're running short of time.
All right.
I'd love to have you on. Love to have you on again. Plug the book before we go.
All right.
I know you've got a book out. I'll put a link in the show notes about where to find your book on Amazon. And thanks for taking the time to talk to me today.
Absolute pleasure to think about these things, because there's always stuff you're missing, and you refine the thinking. So it's great to have an opportunity to chew on these matters as we try and figure out how to do better tomorrow.
Reinvent is brought to you by Millicent Labs, building the financial infrastructure of tomorrow, where the power of Web3 meets the simplicity of fiat. Learn more at millicent.io.